Hello. In this video, we will be discussing LIFO reserves and LIFO liquidation. First, I just want to go over the different inventory cost flow methods that a company can adopt. And if you've watched previous videos, we've covered each one of these in detail. But the thing I want to really highlight with this particular slide is, and you can pause to take a deeper, just a look at everything, is how for each method, and for I'm specifically going to focus on FIFO versus LIFO, but you can see with FIFO, first in, first out, that your cost of goods sold will be lower, thus making you have a higher gross profit and net income, and your inventory balance will be more at the current cost of what you paid for the inventory, because what's remaining in your inventory is the items that you bought or the inventory that you acquired more recently. Versus a LIFO, right? Last in, first out, your most recent inventory that was purchased is going to go into your cost of sales. And in times of increasing prices, which is typically the case, typically prices over time increase, we not decrease. So for LIFO, your cost of goods sold will be higher because it's the most recent purchase goes into your cost of goods sold, and thereby lowering your profit. But your inventory will be at a lower amount usually, because those items will consist of the older inventory, or the inventory that you purchased first. This slide just kind of summarizes the impact of each of the different methods that we have gone through in other videos. But I want to focus on the FIFO versus LIFO, and you can see under FIFO, you'll see the 71.5. You should recognize that number from the videos, and that was the cost of goods available for sale. And the way we allocate that number between ending inventory and cost of goods sold is different depending on which inventory method we choose. But focusing on FIFO versus LIFO, you see them FIFO versus LIFO, their cost of goods sold is lower, right? Which means your net income will be higher under FIFO than LIFO. And under FIFO, the inventory balance is higher versus LIFO, right? 33 versus 25. And that's because the more recent costs in FIFO are staying in your ending inventory, versus your your oldest acquisitions or oldest purchase of inventory is what's going into your cost of goods sold, which is why that is lower. So during periods of rising costs, FIFO results in a lower cost of goods sold and higher ending inventory than LIFO, and the lower cost of goods sold equals higher net income, and that's going to come into play really soon. And the opposite is true during periods of declining costs, but that's a lot less likely. So why do companies choose one method over the other? Well, one is they want to match the physical flow of goods, even though that is not necessary, meaning it's not required. But in general, companies usually sell their oldest goods in inventory first, which matches the FIFO flow of the physical goods. And if you have a company where the inventory kind of comes from a whole bunch of different items, then maybe the average cost method might match your physical flow better. And there's actually very few inventories that flow physically, the inventories physically flow in a LIFO manner. So you can choose any which one you want. It doesn't have to follow your actual physical flow, although that might be helpful, but not necessary, not required. So we've said before that under LIFO, in times of rising costs, your cost of goods sold will be higher, which means that your net income will be lower. And while to the financial reader or the financial user, a company might not want their net income to be lower, right? Because that doesn't look so good. For tax purposes, a company does want lower net income because then they're going to pay less tax. Well, the IRS says that if you want to use LIFO on your tax return, okay, to measure your taxable income, which will result in lower taxable income, then you must use LIFO for external reporting purposes, meaning that's what you have to report on your 10K. You have to use it, the LIFO, and this is called the LIFO conformity rule. So if you're using LIFO for taxes, resulting in lower income tax, then you have to use a LIFO for external reporting purposes. However, so external reporting purposes is what you report to the public, to your creditors, to your investors. It's what's reported on the 10K on the stock, as part of the SEC filings. However, it's not required to value your inventory and cost of goods sold for internal purposes. So what many companies do is that for external purposes, external financial reporting, they report on the LIFO basis. But for internal reporting purposes, they will report it on the FIFO basis. And the reason for that is because, well, first here's the reasons. There's record keeping cost for LIFO is very expensive, but also here's kind of the big one is that a lot of bonus programs or profit sharing plans that companies have are reliant on your net income. So the higher the net income, the higher the bonus or profit sharing is. And so under FIFO, your cost of goods sold is lower, therefore your net income is higher, which is mainly why companies like to use FIFO for internal reporting purposes. So what happens is internally you have FIFO, your inventory is based on FIFO, and externally you have to report on LIFO. And in times of rising costs, under FIFO, your inventory is higher than what it is under LIFO. And you have to kind of go from your FIFO amount to your LIFO amount. And that's done via a LIFO reserve account. And so we're going to go through an example, and I think it'll make more sense. So DoubleTree Corporation began operations in 2027. The company maintains its internal inventory records using FIFO, but reports the inventory and cost of goods sold on LIFO. So internal is FIFO, external LIFO. And here's the inventory information we're given for the first 3 years of operation. Here's your FIFO ending inventory, LIFO ending inventory, and your FIFO cost of goods sold. So for purpose of this class, we're not calculating the LIFO ending inventory versus the FIFO. We're just given that information in the problem. So let's focus on 2027. And 2027, our FIFO, which is internal, and LIFO is external. So we have to convert basically our internal books to our external, what we're going to report on our 10K. And so FIFO inventory is 120,000 and LIFO is 110,000. So we have to reduce our inventory. We have to book something to reduce our inventory balance. And we do this via the LIFO reserve account. And that is going to be a contra asset account to inventory. And if you recall, a contra asset or a contra account, but in this case, a contra asset account goes on the asset section, but instead of having a normal balance of a debit, it has the opposite. It will have a normal balance of a credit. So we need to decrease our inventory by 10,000, right? It's 120. We need to report it on 110 for external purposes. And what we do to decrease inventory, usually we would credit inventory, but instead we're going to credit this contra asset account called LIFO reserve. So we credit LIFO reserve 10,000, and the other side of the entry is debit cost of goods sold 10,000. So here's kind of like what happens to the numbers. Our FIFO inventory started at 120. We credited, we reduced that amount through the LIFO reserve account to get to our LIFO ending inventory. At the same time, the FIFO cost of goods sold is $600,000 under FIFO that was given to us. And we have increased it through this debit right here. We've increased our cost of goods sold. So our LIFO cost of goods sold is $610,000. Let's move on to 2028, right? In 2028, we're told that the FIFO, you're just going to focus on 2028. We're told that the FIFO ending inventory is 160,000 and LIFO is 130,000. So we need to, our internal books say 160, our external books need to say 130. So what we need to do though, the LIFO reserve is a contra asset account. So it's a balance sheet account, right? Which means that the balances carry over year to year. And in 2027, we booked a credit of $10,000 to the LIFO reserve. The difference in 2028 between LIFO and FIFO means that we need to have a total LIFO reserve of 30,000. So our total LIFO reserves should be 30,000 at the end of 2028. And so we have a balance of 10, it needs to be 30. So we need to credit our, think of this as like a T account, right? We need to credit our LIFO reserve by 20,000 to get it to become the 30,000 balance right here. And so then our debit goes to cost of goods sold. And so now when you're presenting on your financial statement, you would say, here's my FIFO ending inventory of 160, which comes right from right here. And that my ending balance of my LIFO reserve is 30,000. So I'm going to decrease because it's a contra asset account. And so my LIFO ending inventory is 130,000. So that would match this number right here. Same way with cost of goods sold, my FIFO cost of goods sold is 720, which we're told, that's right there. We have we've posted a journal entry debiting cost of goods sold by 20, which increases it. So our LIFO cost of goods sold is 740. Let's move on to the final year, 2029, and we are told that our FIFO ending inventory is 175, our LIFO ending inventory is 150. So we need to have $25,000, right, to get it from here to here in our reserve. That needs to be the ending balance in the reserve should be $25,000. So here's our T account. So again, we started with 2028. The balance in our reserve was 30,000, right? That's from right here from the previous slide. And we need to get it to be 25, which means we would need to debit the LIFO reserve by 5 in order to make that happen. So here's our debit to LIFO reserve, and then our credit would then go to cost of goods sold. So when we look at our 2029 financials, beginning inventory, FIFO inventory is 175, which matches right here. Our ending LIFO reserve is 25, which is right there, making our LIFO ending inventory to be 150,000, which is what we wanted. Additionally, that line should have gone right there. We have our FIFO cost of goods sold right there, 850, but we have reduced it by 5 with our journal entry, and therefore our LIFO cost of goods sold is 845,000. So you would show this reconciliation in a note to the financials as part of a disclosure. And then on the face of your financial statements, you would have this. You would have the LIFO ending inventory and the LIFO cost of goods sold. That's what the reader of the financial statements would see directly on the actual financial statement. So here's kind of what a company, a Caterpillar Inc. did in 2021 and 2022. They maintain FIFO inventory for internal purposes and LIFO externally. So they show inventories at FIFO less your reserve, and that's my inventory at LIFO. Okay, we're going to be talking about what's called a LIFO liquidation. So under LIFO, we know that the last units purchased are assumed to be sold first, right? So typically our cost of goods sold are higher, which means our net income is lower, which is why we like to use it for external purposes because it reduces our taxes. There are instances where companies will sell more inventory than they actually purchased during the year. So think about like if you have a seasonal company, right? Think of maybe Halloween Spirit. And we're talking about big corporations and stuff, but just so you can kind of understand the methodology. Spirit Halloween buys a whole bunch of inventory, right, and sells them through October 31st. And then October 31st comes and they're just trying to get rid of all their inventory. And so they're not buying any more inventory. They're just selling whatever they have. In that situation, you would have a company where there are more units sold during a period than being purchased. Or maybe you have a supply chain disruption where you're not even able to buy inventory, even though you want to, you cannot, but you're still selling your inventory. In that situation, again, more units sold than purchased. Or if you have a recession, that could happen. Or if your company is downsizing for whatever reason and you're just trying to get rid of your old inventory, that could happen. So these situations do happen. And when that happens, because under LIFO, it's last in, first out. So then when you start pricing your cost of goods sold, you start going into old layers of inventory, right? Into previous year's layers because you're not actually acquiring new inventory. And these are known as LIFO liquidations. And what happens is that instead of your cost of goods sold being higher as they normally would, you're dipping into older inventory, which means that usually older inventory is you got that at a lower cost. And so now your cost of goods sold is higher than it would be under a normal circumstance. So I'm sorry, your cost of goods sold would be lower than it would be under normal LIFO circumstances. And you also have these old costs being matched with current selling prices, which some companies don't like because it doesn't result in your costs being matched with your current sales. So what happens is if the difference between a LIFO liquidation situation is materially different than if you didn't have that LIFO liquidation method, you need to disclose it in the notes. So it doesn't go into your financials on the face of financials, just in the notes. So let's go through an example and I think it'll make more sense. So National Distributors Inc. uses the LIFO inventory method. The company began the year with 20,000 units at a cost of 16,000. So here, the company, they had beginning inventory was 20,000 units at 16,000 for 320,000. And then they made 30,000 units, they purchased 30,000 units during the year at $20. So that gave them 600,000. And so their goods available for sale is 920,000, and they have 50,000 units in their inventory. At the end of the year, they sold 45,000 units, right? So during the year, they only purchased 30,000, but they sold 45. So now they have a situation where they sold more inventory than they actually purchased during the year. So when that happens, we might have a LIFO liquidation issue, and we have to calculate it to see if the difference is material. So the first thing you have to do is just calculate your cost of goods sold the way you normally would under LIFO, which is last in, first out. So we're told that 45,000 units were sold. So last in, first out says the most recent purchases are the first ones out. So we had 30,000 units purchased during the year. So we're going to price all that 30,000 at $20. And then after that, right, but we sold 45,000 units. We still have to do the cost of goods sold on the remaining 15,000 units, which are our older layer, which was at $16 per unit. So, so this is just a regular LIFO calculation. What you do next is you calculate LIFO. You calculate the LIFO cost of goods sold. If the company had purchased those 45,000 units at the most recent cost, which was $20. So you assume that instead of having them purchased, the latest units that they purchased, the last units were 30,000 units at $20. You assume that all the units that you have sold, all 45, that they were all purchased at that most recent cost of $20. And that would give you a cost of goods sold of $900,000. So right now, under LIFO, your cost of goods sold is $840. Assuming that it didn't have to dip into old layers, it would have been $900,000. But instead, you're actually going to report the $840. So your cost of goods sold is going to be $60,000 less than what it would have been had you not had to dip into those old layers with those old costs. And the reason for that is if that difference between the 840 and 900, which is in our case obviously 60,000, if the difference between your LIFO and your alternative calculation is materially, the difference between them is considered material for your company, you have to disclose that. Why? Well, because right now your cost of goods sold is $840,000, right? Which is lower than the 900, and that makes your net income increase. And a user of the financial statement might think, oh, look, their net income is so high. Make decisions based on that net income number. However, this 840, or I should say the lower cost of goods sold number, is an anomaly because it's just happens to be this year that you sold more inventory than you purchased. So you don't want to mislead the reader of the financials. So you would have to disclose that.